Welcome to Bloomberg Surveillance Early Edition. We're live in a forum, which is why there's quite a lot going on. You also caught a glimpse of our makeup artist, Alicia. We're here in Doha at the Qatar Economic Forum. As you can see, it's also very loud because we have about 300 attendees. The room inside was overpacked. So many people trying to meet some of their peers and, of course, some of their rivals in certain cases to talk about business, inflation, and, of course, investment in this region. So here are your top stories. Elon Musk says he thinks a recession in the near term is more likely than not. Speaking to Bloomberg earlier this hour, the Tesla and SpaceX chief executive also said he wants 80% of North America and half the world on Twitter. President Biden says a U.S. recession is entirely avoidable despite dire warnings from Goldman Sachs. The ECB president restates plans for consecutive rate rises. Stock futures and treasury yields are actually rising. Plus, rail workers go on strike. UK commuters brace for the largest rail walkout in 3 decades as the nation's trains grind to a halt. So definitely our top story overall, but certainly our top story here in Doha, the conversation with the richest person on the planet. Well, techno king of Tesla, chief executive of SpaceX, the boring company in Neuralink, and prospective owner of Twitter. Yes, Musk spoke at the Qatar Economic Forum via video link with our editor-in-chief, John Micklethwaite, and they covered his gradual takeover of Twitter, how he feels about censorship on and off the platform, as well as his views on Tesla's competition in the electric vehicle space. And of course, we can't speak to Elon Musk without discussing his tweets. He's also quite funny in the conversation. That, of course, includes the recent show of support to Republican candidates in the upcoming U.S. primaries and whether he's backing anyone in the next presidential election. So here are some of the highlights.
With respect to the Twitter transaction, there's a limit to what I can say publicly, given that it is somewhat of a sensitive matter. So I will have to be measured in my responses here, such as not to generate incremental lawsuits. Unfortunately,
that seems to be a risk you sometimes manage to overcome.
Yes, a deposition minimization is, I think, important.
Have Twitter given you enough information?
Well, there are still a few unresolved matters. You've probably read about the question as to whether the number of fake and spam users on the system is less than 5%, as Twitter claims, which I think is probably not most people's experience when using Twitter. So we're still awaiting resolution on that matter, and that is a very significant matter. We're awaiting resolution on that. And then, of course, there is the question of will the debt portion of the round come together, and then will the shareholders vote in favor? So I think those are the 3 things that stand in the, that need to be resolved before the transaction can complete.
What about the general state of the economy? Does that weigh on you when you think about this? I mean, you just described it. You have a super bad feeling about the economy. Are you still in that position? I just said to you earlier, Joe Biden has just come out and said that a recession in America is not inevitable. How do you feel about the economy?
Well, I think a recession is inevitable at some point. As to whether there is a recession in the near term, I think that is more likely than not. It certainly isn't. It's not a certainty, but it appears more likely than not. And what do you think?
I'm with you. I agree with you. I think it's more likely. Can I ask you one particular thing to do with the Twitter bid, which is, you are one of the biggest and fastest growing investors in China. Tesla, you've talked about it being 1/3 of your sales going forward. You're now buying Twitter, the kind of public forum for free speech. The Chinese historically don't tend to be very enthusiastic about free speech. Are you worried about whether you can keep those 2 particular horses running? Is buying Twitter going to get you in trouble with the Chinese?
Well, Twitter does not operate in China. Yes. So, and I think China does not attempt to interfere with the free speech of the press in the U.S. As far as I know, because I assume you're not under pressure at Bloomberg from China. So I think I don't think this is going to be an issue.
And in terms generally of that issue of freedom of speech and Twitter, you've talked about Twitter making it even freer and letting more people onto it. Is there a limit at all to who you think should be allowed onto Twitter?
Well, my aspiration for Twitter, or in general for the digital town square, would be that it is as inclusive, in the broader sense of the word, as possible. That it is an appealing system to use. So, I mean, ideally, I'd like to get like 80% of, let's say, North America, and perhaps, I don't know, half the world or something, ultimately on Twitter in one form or another. And that means it must be something that is appealing to people. It obviously cannot be a place where they feel uncomfortable or harassed, or they'll simply not use it.
Elon Musk there speaking to Bloomberg News editor-in-chief John Micklethwaite at the Qatar Economic Forum a short time ago. Now, I am joined by John to get his impression. I mean, this was, John, really a fantastic session. I mean, he answered questions. He was awake, and I know it's 3 a.m. for his time. What struck out the most for you?
Poor man. I think anyone who's 3 a.m. in New York and you're sitting there answering questions from the other side of the world, it was almost sort of interrogation technique.
Yeah, but it worked because we got answers.
We should do that every time.
There you go. This is a warning for all of our guests listening. Next time we do this at 3 a.m.
Imagine having Tom Keane at 3 a.m.
No one deserves to see that. John, when you look at Twitter, so does it feel like he's getting cold feet? I mean, he gave you numbers.
I think it's a mixture. He talks about it very much as if he already owns it. He talks about his ambitions for it, all that stuff. But there's definitely a kind of, I think there's a fidgetiness about the price and what the actual deal is. And I think that's a mixture of two things. I think there is a genuine question mark over what Twitter's numbers really are. I think he has some grounds for interrogation there. And then the second thing is just the economy, the markets, everything's changed. It's a bit like if you might love a house, want to go and live in it, but if all the other houses are suddenly worth 20% less, then you might think you might get a bit of a discount on your purchase.
And John, and he thinks there's a recession coming.
Yes, he said it was more likely than not. He was. I asked him about that, and he was more largely because Biden has just said that he thought a recession was not inevitable. And Musk's point was, nothing's inevitable. He's right, but honestly, this is more likely than not.
I mean, you also talk about politics. I mean, I love it because you actually, covered the world, and you kind of really got like almost raw Elon Musk that you get when you read Twitter. He was funny. What did he say about politics?
Politics, I asked him about DeSantis, the governor of Florida, who Musk and quite a lot of other, in my impression, quite a lot of other somewhat libertarian business people are pushing towards. Basically, business people are not very happy with Biden. On the other hand, I think they see Trump as a liability. And DeSantis is a sort of place where they think he ticks a lot of boxes. They think he's business friendly. They think he's not erratic like Trump. And they're prepared to overlook some of the sort of like slightly less illiberal social stuff. So that kind of thing they're not too worried about. And here is this man who could have some of the same effect of Trump, but in a somewhat saner package. So perhaps it's not surprising he's heading that way. He ducked without he had a chance to say, Musk had a chance to say he wouldn't support Trump, but he decided not to do that.
John, you've met Elon Musk many times. What surprised you about him today?
I haven't met him many times. I think he's, you never know what you're going to get. And actually, if I'd known this was going to be 3 a.m. in the morning his time, I think discretion and bravery and all those things might have been the better part. But I think actually he was in quite good form. I think he was he's one of those people where he's either on for it or he's not. And today he seemed like he was in a good mood.
Himself.
Yeah.
Great job. Our editor-in-chief, John Micklethwaite, there after that interview with
Francine Lacqua.
Elon Musk. Coming up, we talk energy with Sheikh Nawaf Al Sabah, the Chief Executive Officer of Kuwait Petroleum Corporation. We'll ask him whether OPEC can actually do enough to overcome some of the energy crisis and energy supply crisis. This is Bloomberg. economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's focus on energy. Joining us now is Sheikh Nawaf Al Sabah, the Chief Executive Officer of Kuwait Petroleum Corporation, who is also with me on a panel where we discuss the energy transition and, of course, some of the energy supply. So thank you for joining us, and thank you for a fantastic panel. I mean, there's a little bit of disagreement on the way forward and volatility for oil price and where we end up. How do you see the next 18 months going?
It's always tough to figure out what is going to happen in the next 18 months because usually we're trying to figure out what's going to happen for a longer period of time. We invest over the longer period of term. We in KPC don't do short cycle investments for the purpose of short cycle investments. So we think that oil is there for the long term in terms of even in any energy transition. So we may be concerned about what obviously the next 18 months is going to do for financing and for our cash balances, but over the long term, we're quite confident that oil will remain at stable and good enough prices for us.
How does the short term, the war in Ukraine, of course what we're seeing with COVID, change the energy transition? So the IEA said, look, we have to stop with fossil fuels if we're going to save our planet. Does that get pushed back?
No, you have to keep an eye on that as well. But the mistake that a lot of people had made before the Ukraine war was to say this is going to be a war against fossil fuels and that we must stop oil production. Well, the world is using more carbon now than it ever did before, and this crisis in the Ukraine, next to all the humanitarian issues that come with it, shows you that energy is required to fuel the future, and hydrocarbons have a big role to play. Now, can we make the hydrocarbons cleaner and more efficient? Absolutely, that's what we're trying to do, and that's what we're investing in, whether it's through carbon capture, utilization, and storage, using carbon as EOR processes, or really abating the carbon footprint of the oil barrel. We're in Kuwait, and I mentioned this earlier today, we're in Kuwait at the lowest end of the cost curve, both in cash cost and carbon footprint. Now, we need to stay there. That's going to require a lot of investment.
But there are many people, if you speak to climate activists, I mean, they say it's just bad. So does the crisis actually and the war in Ukraine mean that we'll reach peak oil a lot longer?
No, I don't think so.
Will we see more investment in the short term or no?
No, you will see continued investment. I mean, at prices where they are, that is spurring investment. You're seeing some rigs coming back into action in the Permian, and you're seeing U.S. production going up over time. You're seeing a lot of us also continuing to produce. Now, for companies like KPC, we look at the long term, so we're investing right through the cycle. Yeah. But companies that don't do that are putting in more investment right now. The question right now is really about the cash cost of those investments. With inflation and steel prices and whatnot going through the roof, it's going to be an issue.
But the oil price and the energy price is so high right now. When are you expecting these prices to stabilize?
I see a war premium of about $30 in the current price right now. That, but for the war in Ukraine, you'd probably be seeing about $80, $90 barrel oil, which is not that high. And that is adjusted for inflation over the past period. It's actually, it takes you back to the last big bump that we had, somewhere in the $60, $70 range, which is still comfortable. Remember, the energy intensity of the world economy is about a third of what it was about 20 years ago, and it's continuing to go down. So oil prices, yes, they do impact economic growth to a certain extent, but the size of that impact has diminished incredibly.
Do you see any demand destruction in our conversation?
Right now, I don't see it.
Anywhere?
I see demand curtailment of growth. I haven't yet seen demand destruction. We're getting the same calls from our customers demanding the same amount of oil, and in some cases a little bit more.
Yeah, I was going to ask, more calls from Europe?
We're getting more calls from Europe for product. And that actually we are putting forward because we have a new refinery that's starting up production right now. So by the end of the year, we'll have about 615,000 barrels of oil a day converted into mostly diesel and very low sulfur fuel oil that can be used as bunker.
Kuwait is one of the most important players in OPEC. OPEC has pledged to increase production in certain cases. Do you think they can make up for the loss in Russian energy?
A complete outage in Russia right now is not on the table as far as I understand. But if it were the case, no, they don't see anybody, and I don't see the world being able to completely replace Russia at this point. You see demand not really falling, and you're seeing supply curtailed. Then you don't have that. The equation doesn't add up. You're also seeing over time, every year. I mentioned this earlier in our panel today. Every year, the world needs the addition of a new Kuwait to replace the natural decline in oil fields around the world. That's a lot of investment. So add on to that a loss of one of the major oil producers in the world, you're going to be hard pressed to replace them immediately.
Going back to oil prices, I know you're expecting them to stabilize. I think in a couple of years, does it stay at 150 for a while, or does it bounce around?
Well, it's not at 150 right now, but
the trend is towards that.
Yeah, as I said, again, that's a $30 war premium on that. If you take that away, you're still at a stable price. The market is going to set the price, and it was only a couple of years ago when people said, well, we're never going to see $100 oil again, and this is it for the rest of life. Prognosticators tend to have a very short vision, and it tends to be whatever is today will continue into the future. We look at it from a much longer perspective. We think that every source of energy is going to be needed in this energy transition, and we just have to make sure that it is stable and clean.
Okay. Thank you so much for joining us on Bloomberg
My
TV.
pleasure.
Sheikh Nawaf Al-Sabah there, the Chief Executive Officer of Kuwait Petroleum Corporation. Now let's get straight to the Bloomberg First Word News in London. Here's Alice Atkins. Hi, Alice.
Hi, Francine. The European Union's 27 member states are set to formally grant Ukraine candidate status later this week, following a meeting of ambassadors where Bloomberg understands nobody opposed the decision. The bloc is also set to back candidate status for Moldova as well as for Georgia if the latter meets some additional conditions. Britain's biggest rail strike in 30 years starts today after unions rejected a last-minute offer from train companies. The failure of negotiations means some 40,000 staff will walk out today, Thursday and Saturday. The dispute is expected to bring commuter services to a standstill on the 3 days, with severe disruption the rest of the week. Former Treasury Secretary Larry Summers says the US will need to see unemployment above 5% for the next 5 years to curb inflation. In a speech in London, Summers warned the US may need as severe monetary tightening as Paul Volcker pushed through in the late 70s, early 80s. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine?
Francine, I'm going to take it from here, having a little bit of sound issues there with Francine at the Qatar Economic Forum. We'll get back to her shortly. But first, let's get to Fiona Frick, CEO of Unigestion. Fiona, thanks so much for joining us. Look, it is a very strange time. You have the ECB last week laying out their plans to try to keep the periphery in check. Let's start there. Can the ECB do this while at the same time hiking interest rates amid a Fed that's going 75 basis points?
So it's interesting to see that obviously we are changing paradigm. We were in a paradigm of easy money, and I think now there is a coordination between central bank to change that and to go into a sort of reverse Goldilocks scenario. So the US obviously started with 75 basis points. Even Switzerland came with 50 basis points, and Europe wants to do 25 in the next months. It's true to say that it's strange that Europe only does 25 when the sole mandate of the ECB, contrary to the US, is to fight inflation. We could have imagined a bit more.
But this whole idea that the Fed, okay, they might be hiking into a downturn, Fiona, isn't that even more true with Europe, with the problems with energy and gas? Isn't it more dangerous for them to be hiking at this moment?
What is the most dangerous in Europe, I would say, for the moment, is the inflation, which is very high and which creates social tension and inequalities for people, which could result in what we have seen in France with the election. So I think fighting inflation is a priority as of now. Even if it
Fiona, just cutting in, Fiona, because we do indeed have Francine back. So I'm going to throw it back over to Francine in Doha.
Yeah, thank you, Danny. Actually, we had Elon Musk saying a recession was more likely than not. So he was really the big event here in Doha today. Let's have a listen to what Mr. Musk said, and let's talk to Fiona. Here he is.
A recession is inevitable at some point. As to whether there is a recession in the near term, I think that is more likely than not. It certainly isn't. It's not a certainty, but it appears more likely than not.
Fiona, Mr. Musk there saying at some point, do you see the Fed being able to engineer a soft landing?
It's a very difficult scenario. What the Fed has said is that they will be considering a recession if this is the cost to pay to get inflation down. So in regards to their dual objective, today, obviously, they are fighting inflation, even though it could bring the country into recession, and that is perhaps the price to pay.
But there doesn't seem any conviction, even when the markets rise. And I know they're looking at what Biden said about, not an inevitable recession. What does it mean for how you build a portfolio? Where do you want to deploy capital?
So it's complex because obviously, on the short term, there's a lot of fear index and things like that show that there is market stress at the maximum. And generally, you could see a bear market rally because market has corrected quite strongly in the last week. Nevertheless, on the long term, we believe that all the hikes that's going to be necessary to fight inflation are not necessarily priced into the market, and therefore and the recession risk is still not totally priced into the market. So for the moment, it's more of a plausible scenario, but not the base scenario for most of the people. So we believe that following the policy that the Fed is going to put in place, it's rare that such a policy doesn't result into a recession.
Yeah. Fiona, very quickly, how does it all play out in the second half in major asset classes? What's your favorite asset class for the next 6 months?
So we quite like US dollar, and I would think that at one point government bonds, if they continue to go up, they will play their role that they haven't played since the beginning of the year of being a hedge. Obviously, when the 10-year arrive at a level where they can play this kind of parachute scenario, which they're supposed to play in an asset allocation. We also want to have allocation to real assets. Yeah. We quite like the US dollar because obviously the US situation in terms of growth is better than Europe.
Fiona, thank you so much as always. Fiona Frick there, the Chief Executive Officer of Unigestion. Coming up, we speak to Tidjane Thiam, the former Chief Executive of Credit Suisse. He's now Chairman of Freedom Acquisition. This is Bloomberg. Here are your top stories. Elon Musk says he thinks a recession in the near term is more likely than not. Well, speaking to Bloomberg earlier this hour, the Tesla and SpaceX chief executive also said he wants 80% of North America and half the world on Twitter. President Biden says a U.S. recession is entirely avoidable despite dire warnings from Goldman Sachs, while the ECB president restates plans for consecutive rate rises, stock futures and treasury yields rise. Plus, rail workers go on strike. UK commuters brace for the largest rail walkout in 3 decades as the nation's trains grind to a halt. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Doha. We're here at the Qatar Economic Forum. We've had some pretty good conversations on the economy and inflation. And of course, we also spoke to the richest person on the planet. That was our editor-in-chief talking to Elon Musk. He spoke to us at the Qatar Economic Forum via video link on his Twitter takeover plans and how he feels about censorship on and off the platform. Of course, we couldn't speak to Elon Musk without discussing politics and whether he's backing anyone in the next presidential election. So here are some of the highlights.
There are still a few unresolved matters. You've probably read about the question as to whether the number of fake and spam users on the system is less than 5%, as Twitter claims, which I think is probably not most people's experience when using Twitter. So we're still awaiting resolution on that matter, and that is a very significant matter. So we're awaiting resolution on that. And then, of course, there is the question of will the debt portion of the round come together? and then will the shareholders vote in favor? So I think those are the three things that stand in the, that need to be resolved before the transaction can complete.
What about the general state of the economy? Does that weigh on you when you think about this? I mean, you just described it. You have a super bad feeling about the economy. Are you still in that position? I just said to you earlier, Joe Biden has just come out and said that a recession in America is not inevitable. How do you feel about the economy?
Well, I think a recession is inevitable at some point. As to whether there is a recession in the near term, I think that is more likely than not. It certainly isn't. It's not a certainty, but it appears more likely than not.
Can you set the record straight on one thing, which is this issue about the layoffs? I think you said initially that Tesla, 10% of the workforce would be cut, then 10% of salaried would be cut, then salaried would stay flat and overall headcount would go up. What is the number? I know there's already, I think, been a lawsuit about the 10%. Is 10% the goal to reduce the workforce, or what is the number that we should think about, or that you're planning?
Yes. So Tesla is reducing the salaried workforce by roughly 10% over the next probably 3 months or so. We expect to grow our hourly workforce. It's quite clear that we expect to grow our hourly workforce, but we grew very fast on the salaried side, and we grew a little too fast in some areas, and so it requires a reduction in the salaried workforce. And we're about 2/3 hourly and 1/3 salary. So I guess technically a 10% reduction in the salaried workforce is only roughly a 3.5% reduction in total headcount.
The Tesla chief executive there speaking to Bloomberg News editor-in-chief John Micklethwaite at the Qatar Economic Forum just a short time ago. Now, Freedom Acquisition Corp is a SPAC led by the former Credit Suisse chief executive Tidjane Thiam, and it's reportedly willing a merger with Human Longevity, a California-based life science group. This is according to a report in the Financial Times. So let's get straight to Tidjane Thiam to talk about that story, to talk about SPACs in general, and maybe, just maybe, we'll mention Credit Suisse. So, Tidjane, first of all, can you confirm? Good morning to you. Thank you so much for joining us.
It's a pleasure to see you.
Have you acquired something?
We announced yesterday that we are going to merge with a company called Human Longevity, created by Craig Venter. Craig Venter is really the main architect of the Human Genome Project under President Clinton, and he created that company, which mission is to help humans live longer and healthier lives. So it's very simple.
So how difficult, first of all, I mean, SPAC is a buzzword and now people are less interested. How difficult is it to find targets and acquisitions for SPACs?
I think the SPACs have a raison d'être. A SPAC should really be led by sponsors with some delivery track record and credibility, and provided that there's a good set of investors. We have found the process reasonably easy. We have talked to more than 70 targets, never had a difficulty talking to targets. And there are always companies looking for capital, and there are always companies looking for support and people who can guide them, which is what we provide. So, that financial innovation is such that there is always a kind of overshooting at the beginning. So I think not all SPACs fit the description that I just made of what a SPAC should be, and there'll be this market is going to sort itself out.
Yeah. Do you think that would be also with extra regulations? We know the SEC is looking at the SPAC market, maybe making even some of the companies that finance them liable.
I think the SEC is trying to, promote things that are reasonable. More transparency, better communication from the SPAC sponsors. We don't really have an issue with that, and I think it will help in clearing out possibly. How can I say this? Maybe the excessive number of SPACs that have been created.
So what do you say to those that say SPACs are risky assets?
Look, there's no return without risk. Okay, so hopefully they are risky, and hopefully the return more than rewards you for the risk you're taking. They're not riskier than, I think, over equity instruments. You just have to be, part of the reason why we're only announcing a deal now is that we've been disciplined. I think I should add to, good sponsors, good investors, should be investment discipline. okay, we could have done a deal 4 weeks into the SPAC, and I passed up an opportunity that's now trading at $150 from $10. So you have to be disciplined and only do a deal when you find the right opportunity.
Where do you see the world economy going? So are you expecting a recession maybe in the US? And does it make it more difficult to deploy capital as inflation is rising?
I think a recession is unavoidable. When you look at all the forces at work, first of all, the inflation. We can debate the causes, but the inflation is very high. Central banks absolutely need to squash the anchoring of inflation expectations. So they need to get market to believe that inflation will be low, and to achieve that, they need to surprise investors. So I can say, brace yourselves. There'll be more surprise moves from central banks because they need to deal with inflation, and that will have a ripple effect across markets. So there is inflation, there's supply chain issues, I'm sure you covered, there's Ukraine, there's China, and it's a zero COVID policy. So the conjunction of all those factors mean that there's going to be more volatility, and certainly markets will go lower with buying opportunities. For somebody like me who wants to deploy capital and buy, there will be opportunities.
But Tidjane, when you say it's unavoidable, what kind of recession? Is it a short-lived recession? It is a long and ugly recession. And again, what does it mean for also certain parts of the world that are much more vulnerable? Private markets, public markets, but also people that can starve.
I'm unable to predict the shape of a recession. We hope that policymakers and central banks will work hard so the recession is as mild as possible, but yes, some emerging markets, particularly the ones who are not oil producing or oil exporting, are under immense pressure because the rise in interest rates in developed markets makes those currencies stronger. If you have an emerging market, you also need to raise interest rates to defend your currency, and if you don't do that, your currency weakens, and then your imports are even more expensive and everything gets worse. So you can expect pretty aggressive action from emerging market central banks, which will then slow down their economies, and then you get into a kind of vicious circle between developed market and emerging markets slowing down.
Tidjane, you know Credit Suisse intimately. It's in the news for all the wrong reasons every 2 weeks. What's happening at Credit Suisse?
I really can't comment on what's going on at Credit Suisse. I can talk about what I did there and what happened when I was there. We were pretty proud of what we did.
What do you think will happen to it? Is it a takeover target now? How do you even start fixing the bank? I'm
really going to focus on what I'm doing now, which is to raise capital, find targets to invest in. Of course, I watch what's happened with sadness, having spent 5 years of my life at Credit Suisse. I have many good friends and colleagues there who work very hard, and I wish them well. Yeah, do you read the news about Credit Suisse every day, or there must be an emotional link still to the bank, right? From time to time. I only wish Credit Suisse well. Okay, every time there's a new chief executive rumor about someone being in a job for a big job, you always come up. Do you think you have it in you to lead another big bank, a big financial institution? Look, I'm happy with what I'm doing. I was offered, to be honest, quite a few opportunities after Credit Suisse, and I decided not to take them. It's been very refreshing for me to be in touch with the most innovative part of the economy. I said we saw 75 companies. I'm really amazed by the impact that technology is having in the economy across geographies, empowering people, helping fight poverty. And by the way, all the founders I meet are not doing what they're doing to make money. The people at Human Longevity, they want to increase the length of life of humans. Now, they may make money in the process, but it's kind of doing well by doing good. I think is very strong in the generation after mine, and I think that's good news for the world, and I'm thrilled to be involved in all that. Is that different from running a big bank? Because the bank should also service the economy, right? It should service some of the tech companies that you're talking about. No, I've always picked jobs where I could feel good about what I do. So that was the case in insurance. We turned Prudential into a health insurance company, providing health insurance across Asia. At Credit Suisse, what I did was also be a bank for entrepreneurs. That was the tagline, helping entrepreneurs create jobs, develop their businesses, pass it on to their children. So I need to do things that have a meaning. Would you ever go into politics? That would have meaning. And I know France is very close to your heart, and Mr. Macron has had a pretty ugly weekend. I've always believed that what I try to have is influence. I try to be listened to. When people ask me for my view, I give it. For the rest, I just I'm very cautious about making any kind of forecast about the future. So we'll see. Maybe ask me again.
All right, but you'll have to tell Bloomberg first. That
Always.
has to be a deal.
I did my last CEO interview with you, and this is my first TV interview since then, so you always have a special place with me.
Tidjane Thiam, thank you so much for joining us, the Freedom Acquisition Corp chairman, of course, former Credit Suisse chief executive. We have a lot to talk about when it comes to Credit Suisse, so hopefully Mr. Tidjane, of course, will come back on to talk about that. Now, we talk also about inflation with the former Fed governor, Randall Kroszner. That interview is up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here at the Qatar Economic Forum. You can see the real buzz around me as people are talking about inflation, recession, of course, opportunities for the region. Now, the Federal Bank of St. Louis president, James Bullard, has reiterated his view that high inflation is testing the Fed's credibility, and rising prices are putting two of the most powerful people on earth at loggerheads. While the U.S. president says the U.S. is not headed towards a recession, the world's richest man disagrees.
I was talking to Larry Summers this morning, and there's nothing inevitable about a recession.
A recession is inevitable at some point. As to whether there is a recession in the near term, I think that is more likely than not. It certainly isn't. It's not a certainty, but it appears more likely than not.
Well, for a robust conversation, economics and inflation, we're now joined by Randy Kroszner, a former Fed governor and deputy dean at the University of Chicago's Booth Business School. So Randy, as always, thank you so much for joining us. At this juncture in time, with all the inflationary pressures coming from all sides, can the Fed really engineer a soft landing?
It ain't going to be easy. Obviously, they're trying, and that's what they'd like to do. And Jay Powell has sort of tried to say, well, it'll be a softish landing, which means that there's a chance that it could be kind of hard. It's going to be really tough to bring interest rates up enough to bring inflation down and to maintain credibility without at least a significant slowdown, if not a potential recession.
So, Randy, what does it mean, what you think the Fed should do now? Should they, we just had 75 basis points, should they go quite aggressive now to make sure that they get a handle on it so that even if we do get a recession, it's short-lived?
I think it's super important for them to be moving expeditiously now, and whether that's 50 or 75 at the next meeting, I think will depend to some extent on the data. But they clearly have gotten religion about inflation. Rather, they've forgotten about it being transitory. They've said, yes, we're going to deal with it. This is our key problem. We want to try to maintain our credibility, and to do that, they need to move aggressively. And I think by moving aggressively now, if there is a recession, it's going to be much more shallow than if they wait and then have to raise interest rates even further because they've lost credibility and inflation expectations have risen.
So, Randy, why were we so bad at seeing this inflation? I mean, not everyone. Larry Summers had it right, but why were central banks, outrun on this?
Yeah, I think that's a very good question because, Larry, of course, saw it, a number of economists saw it, but most central bankers, or I don't think any central bankers, saw it coming. They were all attributing it to transitory factors. And certainly there were some transitory factors, but I think part of what it was is they'd had such low inflation experience for the last 10 to 15 years that they were thinking, well, there's really not much that generates this high inflation pressure. And if it does, it's just sort of a one-off type of thing. That was a mistake because I think they didn't understand the extent of the supply disruptions. And I think they also didn't think about how the regime shifted so that all of that support that they were providing turned into inflationary pressure, which it didn't a decade ago.
So do you think we're now reading inflation better, Randy, or is there a danger that we'll redo the same mistake once and even twice over?
Well, certainly, I think it's very, very difficult to predict exactly what's going to happen with inflation. There will be supply pressures. There will be pressures related to the war, related to sanctions, which obviously are outside of central bank control. But I think most central banks are now predicting very significant inflation for this year. Like here in the UK, they're predicting that it could easily go to double-digit levels. So I think central banks are being much more realistic about it. I think what they're not being realistic about is how quickly they can bring inflation down. I think it's going to take a while, not just a year, but probably 2 years to be able to get close to 2% inflation targets.
Randy, what kind of, I know this is a difficult question and it depends on what central banks do, but if, the Fed says, or if the Fed is aggressive now, and if we have a recession, what kind of recession will we get? How long could it last and who will be hit hardest?
So people in the lower half of the income distribution are almost always the ones who are hit hardest in one of these, in any type of recession. Now, fortunately, the unemployment rate is extremely low. It's at 40, 50-year lows, and it undoubtedly will go up, but hopefully it won't go up nearly as much as it, or to levels in other recessions of 7-8%. It's possible that we could have something that would be more mild with respect to the labor market, and so only go up in the order of to 5 or 6%, although that would certainly be higher than it is now. I think it's very hard to say because a lot will depend not just on the Fed and central banks, but also on these shocks related to the war and sanctions.
When do you think we'll have, of course, if there's some kind of embargo coming from Russia on oil, it's going to be very, very difficult to come out from that. But when do you think we have an idea of whether we can, really sever that independence from Russia to energy and what that means for inflation dynamics?
Yeah, I think that's going to take a while because, we've seen the debates, whether they're in Europe over reopening or maintaining coal plants, reopening or maintaining nuclear power plants. We have those debates in the US of whether the hydrocarbon producers should be investing more and producing more now, or should they be moving in a green direction. You've got these tensions making it very difficult for the energy market to kind of smooth out. In normal circumstances, in an area where prices are super high, you're going to get a lot of investment, and then that'll bring the prices down eventually. Here, because we want to move away from hydrocarbons, and so many policies in the intermediate to long run are for in that direction, it's harder to get the investment to make that relief in the short run. So I think we're going to see a lot of high prices and a lot of volatility in the short run because you're not going to get the investment to smooth things out.
Randy, thank you so much, as always, for joining us. Randy Kroesner, their former Fed governor and deputy dean at the University of Chicago's Booth Business School, joining us this morning for a good conversation on inflation dynamics. Now, coming up, the UK is hit by the biggest rail strike in 3 decades after talks come to a grinding halt. We'll have much more of that story next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, this week, the UK will experience the biggest rail strike in 3 decades after last-ditch talks over pay and redundancies failed. The walkout by 40,000 workers has been branded total misery by the government. So let's get more on this with Bloomberg's Laura Wright. So Laura, good morning to you. What's the latest so far this morning?
Well, Francine, lucky for you, you've managed to escape the UK at just the right time. National rail strikes on Tuesday, Thursday and Saturday of this week. Half the rail network will be closed, and of the lines that remain open, only a 20% service will be operating. To make things worse here in the capital and add to commuter chaos, Transport for London workers on the Underground are also walking out today. Now, the primary reason behind the strikes is pay. The RMT union are requesting a 7% pay increase for their members. So far, they've only received 2%. They say this simply is not enough. The squeeze on UK incomes is real. I have a chart which nicely illustrates this. You can see that real wages for the month of April, year over year, excluding bonuses, down almost 3.5%. To put that in context, it's the worst reading since the ONS started tracking this data all the way back in 2001. And in reality, the situation on the ground even worse, Francine, because of the cost of living crisis.
Yeah, Laura, thanks so much. Laura right there with some of those pretty hard, of course, hard rail strikes and what it means for people trying to get to work. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kailey Leinz in New York, Anna Edwards will be in London, and this is Bloomberg.
A recession is inevitable at some point. As to whether there is a recession in the near term, I think that is more likely than not.
If you think that we have a recession in 6 to 9 months, the downside from here is substantial. If you believe that the recession is in the latter half of 23 or further out, then you got to buy stocks right here because the earnings will come through.
The pendulum has swung from full greed to, I think, pretty full fear. And that's the good time generally to be buying stocks when they're down.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Elon Musk speaks to Bloomberg about Twitter, Tesla, the economy, and politics. The Tesla CEO spells out the roadblocks to his Twitter deal in an interview with Bloomberg News. A warning from Goldman Sachs. The firm says the risk of a U.S. recession is rising and cuts its economic growth forecasts. And Janet Yellen says to stay tuned for word on how the U.S. and its allies may cap the price of Russian oil. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Kailey, good to see you. So the recession warnings getting louder, or at least more frequent, it seems, and yet risk assets get a boost from somewhere.
Yeah, a little bit of a rebound taking shape today after $2 trillion in value was wiped off of the U.S. equity market last week. So the question really is, will this rebound stick as you do have these recession fears so dominating the market narrative right now? Now, speaking of a rebound, you definitely saw that taking place in Asia overnight. The MSCI Asia Pacific Index snapped an 8-day losing streak to gain about 1.5% overall. Now, China was a bit of a laggard within that. There are concern around COVID outbreaks in Shenzhen and Macau. But broadly speaking, the global narrative really is focused on central bank policy, the tightening of it, and what that means for economic growth. Interestingly, though, in Australia overnight, you saw the two-year yield coming in 12.5 basis points after the RBA Governor Philip Lowe pushed back on the idea of a 75 basis point hike next month. So maybe not following the Fed in that regard. Also, one central bank definitely not following the Fed would be the Bank of Japan, not tightening policy as the Fed is. And so you continue to see the weakening of the Japanese yen. We're at 135.29, remaining right around the lowest level since 1998 on dollar yen. And finally, in commodities, I just wanted to point to palm oil. If you remember back in April, Indonesia halted exports of palm oil due to inflation. That sent prices to a record high. Now palm oil actually is in a bear market, falling about 3.6% overnight as Indonesia starts ramping up those exports once again. So maybe that helps the food inflation story, Matt.
Certainly Nutella could be cheaper. Take a look at what we're seeing here in U.S. futures, up 2% after the massive wealth destruction that we saw last week. Kailey just pointed out $2 trillion in U.S. stocks alone. The U.S. 10-year yield coming up a little bit as investors let go of that paper right now. 326 is the level there. Of course, last week we soared at one point to almost 340 and came down substantially. We came down substantially in NYMEX crude. On Friday, there was a 7% drop in oil prices. So even though we touched 124 last week, we came off and now we're headed back up, but only to 111.85, and then that down and then back up story is nowhere more evident than Bitcoin. We went below $18,000 on Saturday. I was glued to my Bloomberg all weekend, which actually is not unusual. But then we bounced back up. So now 21,387. It looks like investors, at least on the retail side, thinking that we can hodl at these levels. Anna, what do you see in terms of European markets?
European equity markets here for the second day of the week. Of course, we had gains here in Europe yesterday, so part of what the U.S. session is set to do, I suppose, is catch up with some of that. But we've got more to add here on the positive side. So European stocks once again moving higher as we see those U.S. futures pick up the baton and run higher still. So the CAC 40 and the Xetra DAX both showing gains of over 1%. And in fact, it's broad-based. It's pretty well spread. We are higher on most sectors across the European equity markets this morning. In terms of that risk appetite, and it does seem to be quite a risk-on day, with not a huge number of very evident catalysts for that, other than, as Kailey was referencing, the rebound from the losses of last week. We do see risk-on moves in other asset classes as well, including FX. Euro is higher, the pound is higher, both against a broadly weaker dollar, as appetite for risk seems to have increased from somewhere. So 105.74 on the euro. We heard from the ECB a lot of recommitment to the rate hike path ahead and talk about fragmentation and the tools to fight that ongoing. The pound also up by 0.4%. Hugh Pill, the chief economist at the Bank of England, saying that the Bank of England would sacrifice growth to achieve inflation goals, which struck me as a fairly candid comment and very relevant in other geographies as well. Brent crude up by 1.1%, but as Matt was saying, a big drop during Friday's session on oil prices broadly. We were up at $120 a barrel back on Friday, $115 the handle now. And here's natural gas up again. Last week we saw the biggest increase in natural gas prices since the start of the war in Ukraine. Now we are seeing further gains day after day, it seems, on gas prices as we watch what Russia is doing, turning down the amount of flow it will send from Russia into Germany, into Europe more broadly. Also at the Qatar Economic Forum, seeing calls from the Qataris for more investments into LNG and the like, Kailey.
All right, Anna, certainly there is a lot going on today, and there is going to be more going on throughout the rest of this Tuesday. Of course, we will continue to follow the Bloomberg Qatar Economic Forum, which kicks off with a stellar lineup of guests, including former Treasury Secretary Steve Mnuchin and the Blackstone CEO Steve Schwarzman. Then we'll also hear from Richmond Fed President Tom Barkin and Cleveland Fed President Loretta Mester, who will both be speaking at events. What will they say in light of that 75 basis point hike last week? And finally, we'll get some U.S. economic data, including existing home sales at 10 a.m. New York time. Housing somewhere you're really starting to feel the impact of higher rates already, Matt.
Yeah, absolutely. We'll watch all that, but we're paying particular attention to what Elon Musk says this morning, warning that a recession looks more likely than not. He spoke to our editor-in-chief, John Micklethwaite, in an exclusive interview at the Qatar Economic Forum in Doha.
A recession is inevitable at some point. As to whether there is a recession in the near term, I think that is more likely than not. It certainly isn't. It's not a certainty, but it appears more likely than not.
Bloomberg's Guy Johnson joins us from the forum for more on that interview. So we covered an incredibly wide range of topics. Obviously, Guy, there's a lot to talk about with Elon Musk, from Tesla to Twitter. What were your takeaways?
So many takeaways, Matt. He covered, as you say, a huge amount of ground, and this in the middle of the night over in the United States. He joined us by video link. To be honest, I am rapidly coming to the conclusion that Elon Musk simply does not sleep. But yeah, it was a pretty wide-ranging conversation. I think that probably puts it mildly. He talked about the recession. You just heard what he had to say there. Remember, he has been fairly downbeat about the outlook for the economy for a while now, and he is laying off staff over at Tesla. He talked about Twitter there. I have to say, just kind of reading between the lines, doesn't feel that passionate about Twitter anymore. He doesn't talk about it in the way that I've heard him talk about it in the past. So I'm just wondering kind of where we are in that process in reality. He doesn't really have that kind of that instinct that he really is kind of all in here on this one. He talked about Tesla. To be honest, Matt, I thought the Tesla stuff was probably some of the most interesting comments that he made here. He talks about the idea that Tesla remains supply constrained. He talks about the fact that there are long waiting lists for a Tesla. He said that's not by design. It's simply the fact that we are struggling to make the cars that are needed to satisfy that demand. He's not worried about competition. He's worried about the supply chain. That is his real focus right now. He, of course, talked about what is happening with crypto. We've talked about the volatility already on the show as to what is happening there in Matt's weekend. I'm sure that probably is a reflection of reality of Matt's weekend. But he did say that he said he support Doge, and he will continue to support Doge, Kailey, and I think he's going to continue to do that. And he wrapped it up, I have to say, with some fairly interesting comments on AI. This obviously comes after Google had some issues there, but he has in the past talked about the need for a regulator for AI, and he reinforced that comment today. But I thought it was a fascinating conversation for a man who was speaking in the middle of the night. He seemed relaxed, he seemed calm, he seemed kind of into all the subjects that we were talking about, and he was pretty relaxed to talk about most of them. He didn't, though, which I think his lawyers are going to be happy about, Kailey, make any significant headlines here that they're going to be worried about.
Yeah, someone on Twitter called it the polite version of Elon Musk guy, and who needs sleep anyway? Bloomberg's Guy Johnson in Qatar, thank you so much, and we'll have more of that interview with Elon Musk later on this hour. Meanwhile, Elon Musk was talking of a recession, but he is not the only one. Goldman Sachs economists cutting their U.S. growth forecast and warned that the risk of a U.S. recession is rising. Let's get more with Bloomberg's Danny Berger. And Danny, I believe it's 48% implied odds over the next 2 years?
Yeah, exactly. So that's over the next 2 years. Just in the next year, it's 30%. Kailey, that's an upgrade from 15%. And if we don't get a recession in the next year, then the one for the year after that is 25%. So a lot of numbers to throw at you, but basically just to say recession odds are rising. And Goldman analysts basically saying because the Fed has tied themselves to headline inflation. In other words, they've tied themselves to energy prices, writing, we are increasingly concerned that the Fed will feel compelled to respond forcefully to high headline inflation and consumer inflation expectations if energy prices rise further, even if activity slows sharply. That's the key thing, because activity could slow, prices could drop elsewhere, but as long as energy remains high, the Fed is going to have to hike rates. This kind of gets to what Larry Summers said, that 5% unemployment would be the rate we need to hit for 5 years in order to get inflation back down. I mean, that certainly sounds like some recessionary forces there. The question after that, once we've decided, okay, higher recessionary odds, what's priced in? Here, there's also a lot of disagreement. Morgan Stanley, Mike Wilson over there says that we need to drop another 15 to 20% in order for the stock market to reach an inflationary situation where it's reflecting that. Goldman, Peter Oppenheimer says we're already pricing in a mild recession. And Marko Kolanovic, ever the bull, about a month ago, and has been saying 70% or more are the odds the stock market is pricing in for a recession. And that is too much, Anna. Perhaps one of the lone ones to not see a recession coming, or at least higher odds of it.
Of course, that conversation with Elon Musk covered the likelihood of recession. For what it's worth, his view, recession in the near term, more likely than not. Danny, thank you very much. Bloomberg's Danny Berger with the latest on recession thinking on Wall Street. How does that sound to the White House? President Biden has reiterated that a U.S. recession isn't, in his view, inevitable. He spoke following a conversation with former Treasury Secretary Larry Summers, who sees a significant chance the country will find itself battling stagflation.
I was talking to Larry Summers this morning, and there's nothing inevitable about a recession.
Joe Matthew, Bloomberg Washington correspondent, joins us now from D.C. for more. Second day in a row, I think, we've had this commentary from President Biden that a recession is not inevitable.
And that's his job as the president to say that, right? Of course, a recession is not guaranteed here, although we will remind everyone, to your point, Larry Summers has been talking about this, among the first to ring the bell on inflation, among the first to call for higher interest rates, and now, of course, warning of potential stagflation. But listen closely to what the president said. If you kept the tape rolling there for a moment, nothing is inevitable about a recession, he said, and went on to say, I think we're going to be able to get a change in Medicare and a reduction in the cost of insulin. He's referring to a package of legislation aimed at lowering costs from the Build Back Better plan that failed to pass last year. Democrats are talking about a smaller version right now that could pass through reconciliation with Democrat-only votes. But there is no legislation yet to vote on and no guarantee that that could pass. So if that's what he's thinking right now, along with some other ideas, including a gas tax holiday, maybe even gas pump rebate cards, these would require Congress to sign off on these, and we don't know that there's any path through the Senate on them. So the president obviously doesn't want to talk down the economy. They're looking at a lot of different options right now to try to control prices, but there's not a lot new here.
Treasury Secretary Janet Yellen speaking, saying talks are continuing on how the U.S. and its allies might cap the price of Russian oil exports. Listen to what she said yesterday.
We are talking about price caps or a price exception that would enhance and strengthen recent and proposed energy restrictions by Europe, the United States, the UK, and others that would push down the price of Russian oil and depress Putin's revenues while allowing more oil supply to reach the global market.
It's so great when trained economists talk about price caps like they're a good idea. That's what politics can do to people, right?
Well, you're the expert, Matt. All I know is this is not new. We sit around listening to these long hearings in Washington for a reason. This is something that was floated a couple of weeks ago by Yellen before the Senate Finance Committee when she was in testimony. Essentially, they would ban insurance for crude oil for Russian oil shipments above a certain amount, which would be the equivalent of a cap. I mentioned, again, she talked about this a couple of weeks ago. The whole point here, though, is to kind of have your cake and eat it, too, to keep Russian oil flowing, but also depress prices at the same time. And it's unclear, Matt, if that's possible.
All right, Bloomberg's Joe Matthew in Washington for us. Thank you so much. And of course, you can listen to Joe every weekday on his radio program, Sound On. That's at 5 p.m. Eastern Time on Bloomberg Radio. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. And I have to begin with Spirit Airlines because this saga with bidders from Frontier and from JetBlue continues. Now JetBlue upping its offer price for Spirit by $2 a share, now to $33.50, up from that $31.50 they offered earlier in June. They really want to buy this discount airline. As a result, Spirit is up about 13% in pre-market trading, still though below that offer price, trading at $24 a share. Another stock moving higher I wanted to check on is Coinbase, because basically all crypto-related equities are benefiting today from the stabilization, the rebound we are seeing in crypto. After, over the weekend, we saw dramatic price action, a plunge down below $18,000, then a spike back up over the last couple of days. You are seeing Coinbase benefiting from that as U.S. markets reopen for trading today, or at least pre-market trading at this point, up about 4.5%. And finally, we talked with Guy Johnson there about Elon Musk's, the conversation he had with John Micklethwait, including headcount at Tesla. Overall headcount going to come down about 3.5%, at least in the near term. But he actually thinks headcount will be higher a year from now. So investors may be taking a bit of optimism from Elon Musk's comments, even if he is worried about the supply chain, because Tesla shares up about 3% before the bell, Anna.
Coming up next on the program, then, Kailey, we will get back to the market conversation. We'll talk to Nigel Bolton, BlackRock Fundamental Equities co-CIO. How do the warnings around recession sound to him, and what do they mean for investment strategy? And we'll be live from the Qatar Economic Forum, of course. We'll be speaking to the Vitol CEO, Russell Hardy. Important conversation around energy at this point. Plus, Jenny Johnson, Franklin Templeton Investments CEO, joins the program. This is Bloomberg.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special Equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
Back to Bloomberg Surveillance. This is the early edition. We are simulcast on both Bloomberg Radio and Bloomberg Television. I'm Matt Miller here in New York with Kailey Leinz, Anna Edwards with us out of London. I'm looking at the S&P 500, which has come down substantially. You may have noticed, especially if you're long stocks, opening up your 401k every month and seeing that you're losing more and more money. Earnings estimates have not come down at all right now. So the question is, where is the street on what companies can make if what we expect from their future income in terms of stock prices is so much lower? Nigel Bolton joins us right now, co-chief investment officer of BlackRock Fundamental Equities. Nigel, what do you think is wrong? Are analysts just yet to catch up with the whole picture? Have they not factored in inflation and margin compression?
I think you're spot on there, Matt. Look, analysts are kind of listening to companies, and companies will tell you what's kind of just happened or maybe what's just happening immediately. But you have to really look forward, and that's what the equity market's doing. It's looking forward, and it's telling you that there is likely an earnings recession coming. And I think, that's my kind of base case now, that we have an earnings recession coming. This is not, we don't believe, a GFC type bear market. This is more of a cyclical standard kind of type bear market. So from an earnings perspective, I would be expecting earnings to be coming down somewhere in the region of 10 to 15%. There is not the big imbalances out there that would really justify a bigger reduction in earnings at the moment.
What about a bigger reduction in prices, though, Nigel? You have Mike Wilson over at Morgan Stanley saying the S&P needs to drop another 15 to 20% to about the 3,000 level to accurately price in the growth risk, the economic contraction we are facing. What is priced in? What is enough?
I think he's probably about right, Kailey, to be honest. I'm looking at 3,000 on the S&P 500 as an area where you really want to start thinking about buying then. If you look at where the S&P 500 is on a Shiller basis, it's still pretty expensive. And it has to get back to the 3,000 level to get you to the long-term median, which is around about 24 times on a Shiller PE. So to me, the S&P is still an expensive market. Remember, we were back at 3,000 in December 2019, so it's not that long ago. It seems, we've had a very strong market. I think we've probably still got further to go.
And over here in Europe then, Nigel, I know that the banking sector is something that you're watching closely. You like the banking sector here in Europe. Is that based on higher rates? Is it all about share buybacks? Is it all about M&A or all of the above?
We do like the bank sector in Europe. Look, one is it's really cheap. Second is the balance sheets are in pretty good shape. You've got cash share buybacks coming. You've got higher dividends as well. And I think everybody has a kind of muscle memory of the GFC, and this is terrible for the banking sectors. But actually, banks can outperform in a relatively moderate recessionary environment. And I think that's the kind of environment that we're thinking about. So we do see that sector as being attractive. It's also a sector that is pretty underowned. A lot of people have avoided that sector. And just on the European market overall, the European market is actually back at its long-term average in terms of the Shiller PE, whereas the US, as I mentioned, is still 20% expensive. So I think Europe is looking attractive from a valuation perspective, but there's still a lot of uncertainties, related to the war, related to potential recession there.
So Europe looks attractive, a lot of uncertainties. Where does that leave you on commodities? And Europe does a good line, of course, in energy businesses and basic resources. I ask it that way because actually we've seen quite divergent trends of late in oil being pushed higher by geopolitics, and then the metal space, which looks very different and a lot weaker. Where do we stand on commodities?
Yeah, so look, we see natural resources as being a really good kind of hedge for more inflationary pressures over the medium to long term. In the short term, we've had some pretty strong performance across the market, and that differential you're pointing out really is reflecting the expected demand-supply imbalances. Energy, we see as having a continued imbalance on the supply side there, so price is likely to remain high, and we do see that sector as both attractive in the renewables and in the more traditional space as well. And then when you look at the kind of the mining sector, if you like, again, there's still a long-term imbalance of supply. We've had a lack of investment over the last 5 or 6 years. So the fundamentals stack up pretty well there. But in the short term, you're probably a little bit more susceptible to weakening demand.
Well, of course, the energy complex and the higher prices we are seeing is something Goldman Sachs cited in its call potentially for a 30% chance of recession, saying that the Fed is going to respond to headline inflation, which, of course, energy contributes to. And that means that they will continue to be aggressive even if data starts to deteriorate. I'm wondering where that leaves the bond market if you have an aggressive Fed on the one hand, but fears on growth on the other, and where your yield call then comes in back to equities.
Yeah, look, I think the bond market is in a pretty tough place overall. I still think that, we've had an incredible 40-year, frankly, bull market in bonds. And I think the low of yields was sort of seen over the last year or two. We're going to track a little bit higher from here. We've already come a long way, but I think it's going to be very difficult to see yields falling anytime soon.
All right, Nigel Bolton of BlackRock, great to get your thoughts this morning. Thank you so much for joining us. Now, keeping you up to date with other news from around the world, here's the first word. Bloomberg has learned that the European Union's 27 members are set to formally grant Ukraine candidate status later this week. That's a first, but highly symbolic step on the long path to becoming an EU member. EU leaders will discuss Ukraine's membership bid this week. In the UK, the biggest rail strike in 3 decades is underway. Unions rejected a last-minute offer from train companies. Some 40,000 workers are walking out today, Thursday, and Saturday. That's bringing commuter services to a halt and threatening to cause transport chaos in London. And cryptocurrencies are showing signs of recovering from last week's rout. Bitcoin rose and held above $20,000 after falling below that level last week for the first time since 2020. So-called altcoins also are gaining. And Matt, of course, this is a conversation we will be having later on today on Bloomberg Crypto, coming up at 1 p.m. Eastern time. The question really is the bottom in now? Is this a dip finally that people are able to buy?
Yeah, I think that was the question for a lot of people over the weekend, but certainly they were buying the dip nonetheless. It is interesting that there's now a short Bitcoin ETF that maybe will cushion falls like this in the future because people will have to cover when it drops. But there's certainly a lot to talk about, and I hope everyone tunes in at 1 p.m. Eastern time for Bloomberg Crypto.
1 p.m. Eastern time for Bloomberg Crypto. Got it. We definitely will. A lot to talk about. Yeah, absolutely. An incredible weekend of volatility and a little bit of recovery, a little bit of stabilization then just in the last 24 hours or so. Coming up then on the program, we will be back live to the Bloomberg Qatar Economic Forum. The Vitol CEO, Russell Hardy, speaking to Bloomberg next. We'll get into a conversation about energy markets, about transportation of oil globally. We will talk about that with Russell. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Elon Musk speaks to Bloomberg about Twitter, Tesla, the economy and politics. The Tesla CEO spells out the roadblocks to his Twitter deal in an interview with Bloomberg News. A warning from Goldman Sachs. The firm says the risk of a U.S. recession is rising and cuts its economic growth forecasts. Janet Yellen says to stay tuned for word on how the U.S. and its allies may cap the price of Russian oil. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, European equity markets, US futures, all signaling we're trying to turn the page, trying to get over what happened last week, the volatility and the heavy selling of risk assets that we saw towards the end.
Yeah, maybe the idea is that we fell too far, too fast last week or the last 2 weeks. We're looking at S&P futures up almost 2% this morning. So could be a big rally at the open, and investors are letting go of 10-year debt, the yield rising to 326. I will point out also that we are not inverted in 2s, 10s. We are still inverted when you look at the 5s, 30s. But a lot of assets came down substantially on Friday and are now, or Saturday, and are now heading back up. Oil is one of those with an almost 7% drop for NYMEX crude. So if you remember NYMEX getting close to 124 last week, it came down a lot, and now it's headed back up. A 2% gain to 111.85. And then Bitcoin. I was just shocked this weekend to watch it fall below 18,000. That's because there's a level around 19,000 and change that everyone was so sure would hold. It did not. Nonetheless, it was a signal to, I'm guessing, retail investors, maybe some institutional, maybe Mike Novogratz went in and bought some more to buy. And now Bitcoin is back up to 21,219. There's also a short Bitcoin ETF that's newly issued. We'll be talking about that in our crypto show today. Have I mentioned this? We have a crypto show every Tuesday, me and Kailey at 1 p.m. Eastern.
You can't plug it enough, Matt. We want everyone to tune in, of course. And as you see that rebound taking place for Bitcoin, you are seeing the benefit, reaping the reward of that crypto-related equities in pre-market trading. The likes of Marathon Digital up 7.4%, right? Blockchain is up nearly 6 percentage points. So a lot of that complex is doing well on this Tuesday morning as the U.S. gets back from that long holiday weekend. Now, it's not Merger Monday because it's not even a merger agreement and it's not a Monday, but you are seeing a lot of deal action in the airline space, of course, when it comes to Spirit. JetBlue really wants to buy this company, wants to outdo rival Frontier Airlines bid, and as a result, it's continually raising the price for Spirit, up now to $33.50 a share. That's $2 higher than the offer they made just a few weeks ago. As a result, Spirit is up nearly 13% in early hours, trading around $24 a share. But really, a lot of the travel complex is doing well today. Any deal action aside, Anna, all the airlines and cruise lines are amongst some outperformers in pre-market trading, including United, up about 3.4% before the bell.
We had a lot of good content coming through from the IATA conference in Doha just yesterday. Worth looking up on the Bloomberg terminal if you were out of the office yesterday. A lot of conversation there about aviation. Stocks Europe 600 then back to Europe, Kailey, and we see European equity markets moving higher, up by around 1%. We went higher yesterday in Europe. More to go, though, it seems, finding this risk appetite from somewhere, despite all of these headlines coming through now about who is calling a recession and when. The euro is gaining. The pound is gaining. This is all really part of the weak dollar that we're seeing as a result of a risk-on tone in markets today. So the euro up 0.6%, the pound up 0.5%. More comment on rate hikes and fragmentation tools there with the euro. The pound, interesting that we heard from the economist, the chief economist at the Bank of England. He said that the BOE will sacrifice growth to achieve inflation targets, which is an interesting statement, a candid statement to make at this point. And natural gas, keep watching the natural gas price. This is the European benchmark as we continue to watch Russia turning down the amount of gas that it will send to Europe. And over in Qatar, we've witnessed lots of conversations about just who and at what price and how much investment there needs to be in Qatari LNG, Kailey.
All right, well, speaking of commodities, it's not just natural gas moving higher. Oil also is ticking higher this morning as investors continue to weigh the demand and supply outlook. Joining us now from the Qatar Economic Forum is Bloomberg's Haslinda Ahmed with the Vitol CEO. Has?
Well, that's right, Kailey. Russell is, of course, the man to speak to. Vitol, it is the largest independent oil trader here, giving us his perspective. Russell, I mean, how tight is the oil market right now?
So we've had a very strong start to the year. Things are positive across most supply situations coming into the year, oil and gas. And since the Russian problem, things have obviously tightened further. Prices have moved up, and we're at a level now where consumers are really struggling, really suffering. And what we're worried about is how this then plays out for consumers and the economic consequences of these high prices. So we're beginning to see a little bit of demand drop at the edges because of the high prices.
So where do prices go from here? Some are already touting 150, some say perhaps 200 in the coming months. Do you see that happening?
I think we've got more oil arriving from the OPEC Plus agreement over the next 3 months. The US is producing more oil. The SPR is making more oil available. So I think those rises are less likely today without geopolitical problems.
We have President Biden heading to Saudi Arabia in the middle of July. What kind of conversations do you think will transpire, and what kind of response are you anticipating from Saudi Arabia?
I think that's the $64,000 question. I don't know. I don't know that we can quite read into the visit exactly what's going to happen. Obviously, Saudis are incredibly important to the future of supply and demand because they're holding the spare capacity today. So it's an important meeting and important to read the tea leaves of how the Saudis react to the wider price problem across the world.
Well, let's talk about the spare capacity. I mean, the sense out there is that Saudi Arabia and the UAE can produce 1 million barrels more. Is that accurate?
Yeah, I think we're going to find out because there's going to be more call on that oil over the coming months, and the OPEC agreement allows Saudi to go back to about 11 million barrels a day. And we're going to see how comfortable they are at that production level and to what extent they've got room beyond that as we go into winter. So I think the market's a little bit concerned that we're running out of spare capacity. It's beginning to factor that into prices today.
Well, what's your own sense? Can it produce any more than 1 million barrels a day? How much clarity is there in your conversations with the people within the industry and in Saudi Arabia?
I think it's reasonable to assume somewhere between 11 and 12.
That's it?
11 and 12 million barrels, right. Yeah. So up to another million from where we are today.
We had your head of Asia saying that the U.S. is likely to turn a blind eye to Iranian oil coming to the market despite the lack of a nuclear deal. How are you thinking about that?
I don't think anything's really changed. Volumes of Iranian exports are primarily going to markets that still have relationships with Iran. To be very clear, it's certainly activity that's sanctioned as far as we're concerned, and we won't touch those products or those commodities. And I think merely the point was that as we go forward here, there is a chance still of a JCPOA renewal at some point in the next 6 to 9 months. And until that period is hit, we're probably going to plateau at the kind of levels that we're at.
A lot of attention is also being focused on China and its emergence from COVID. when China does emerge, what kind of demand are you anticipating from China, and how will that weigh on demand and supply in the energy market?
So it's had a very tough 2Q from a demand perspective and a lockdown perspective. So there's quite a bit of growth to bounce back, and obviously the speed at which that comes is quite a concern for the market. Refining capacity has been held back a little bit. Product exports have been held back a little bit so that they can look after their own supply and demand whilst they're in this difficult situation with both COVID and the international supply picture. And so I think we'd certainly expect demand to increase by at least 1 million barrels a day in China, and that will be supportive for international prices.
How about in terms of demand for Europe and the US? We have expectations of a slowdown in both economies.
Yeah, I think the real concern in Europe is really going to be around diesel this winter. As we move away from Russian diesel, where are we going to find adequate diesel supplies? So the market's got time to adjust and move supplies from other continents towards Europe. But I think that's one of the things that's really driving prices, is the concern around diesel.
Supplies remain tight and prices remain elevated. There you have it, Russell Hardy. Anna, handing it back to you.
Haslinda, thanks very much. Bloomberg's Haslinda Amen in Qatar with the Vitol CEO, Russell Hardy. Coming up on the programme, Unresolved Matters. Elon Musk speaks to Bloomberg about his bid for Twitter. We'll bring you some of that conversation. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, Houston Mayor Sylvester Turner. That's at 4:30 p.m. in New York, 9:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Now, we all know, Kailey, what has preoccupied Matt over the weekend, and that was being stuck to his Bloomberg terminal, looking at the volatility in crypto. But Kailey, where does the conversation go from here then, in terms of setting up what should be a really interesting crypto show later in the day?
Yeah, 1 p.m. Eastern time with Matt and I. Really looking forward to it. I think the question really is the bottom in now? Have we seen the worst of the deleveraging, of the selling pressure, the forced selling in crypto? And is the rebound we've seen over the last couple of days sustainable? Anna, we're going to dig into that, hopefully look at some technical charts coming up later this afternoon.
So lots more on crypto still to come. Let's get back out to the Qatar Forum, the Qatar Economic Forum. Bloomberg's Francine Lacqua standing by with Jenny Johnson, Franklin Templeton Investments CEO. Fran.
Yeah, thank you so much. And I am delighted to be joined by Jenny Johnson. Jenny, there's so much going on. We're in Qatar. If you look at the markets, there's a lot of deployment of capital that maybe isn't going to the places where it would have gone 6 months ago. How do you see the active management side of things?
Well, look, active management thrives in volatility, and if we're having volatility for sure. I mean, I think what we've had in the last decade, honestly, since the financial crisis, is where governments were printing money. There was no place to put it, so you were throwing in the equity markets and everything went up. And now what's happening is you're going to have to be discerning about where you're deploying your capital.
So do you see active management back with a vengeance, and it's here to stay?
I do, absolutely.
What does it mean for fees?
Well, so look, you have to get... You have to generate value, right? And if you look in the private markets, I mean, the fees that the private markets have gotten, they're huge compared to a public equity active manager or, passive. On the other hand, they've generated value, right? So, and as companies are waiting longer to go public and that growth trajectory is all being captured in the private markets, they've justified their fees. Having said that, the top performing private equity to the bottom performing have had like a 20% differential return. So picking the right manager is also really important.
So, and this is one of the conversations that you had with our Danny Berger over in Berlin, that super return, right? That, some of the private market is now back, but there's concern about liquidity. How do you see the market overall developing? Are we going to see a gyration towards growth continue?
Look, anybody who could deploy capital for a longer term has had the benefit of what we've called the illiquidity premium with private markets. The challenge now is because you do have companies waiting longer to go public, and you do have banks who aren't lending, they're not using their capital the same way to lend, so it's created the really private credit markets that really the average investor has been left out of that. And that's a problem. So, you know, what I talked about there is we have to figure out responsible ways to bring the private markets to really the average investor. And so a couple of ideas. So one, I think in like a retirement program where you have a managed account and there's an allocation within that fund to private markets. We actually ran this in our solutions group, and if you allocated anywhere from 10 to 30% of a managed account to real estate or private credit, we didn't even do private equity, you got anywhere from 1 to 3% additional kicker in return per year. That's significant over a retirement lifetime.
Jenny, is this money that's coming out of the public markets because of the volatility that would put in there, or is it extra money being pumped into the system?
We were focusing on in the US, they have 401k plans that people take money out of every paycheck and put in. So really it's kind of new money that, you know, and that also is part of what makes it helpful, is there's always money flowing into the vehicle. So we think that that's actually a great place to deploy it.
We had Elon Musk saying, look, a recession is probably coming. He didn't put a timeline on it. Are you expecting a recession, an ugly, like deep, ugly recession?
You know, I don't know if it's a deep, ugly recession. I think one of the challenges is you've got the Fed trying to raise rates to cool off demand, right? And that's normally what you do, and you know, when you have inflation. The problem is we have some real serious supply shocks. The war, China's zero COVID policy, honestly, climate change. You know, some of the big climate events, we had a food crisis prior to the war, and then deglobalization where people are diversifying their supply chains, which probably means that things get more expensive. So, you know, and those are choppy kind of supply shocks. So I think it's we're going to have kind of a tough period here. I wouldn't be surprised if you had a little bit of even potentially some stagflation.
So for markets, it's a nightmare. Do you go to
markets,
cash?
it's tough. You've also taken markets always predict the future, right? So you've actually had a lot of it in the equity markets. Probably have a bit more, but they'll be the kind of the first to come out of it, I think.
Does it mean that actually there are valuations for financial companies that crop up that are attractive for you to buy, for example, in an M&A transaction?
So we approach M&A by looking at it, where do we have a gap in our products? And, you know, look, timing, you never can time that perfectly, so it's about filling gaps for us. And in some cases, it's things in fintech. We actually now absolutely have the broadest capability of any global asset manager out there, venture capital all the way to passive. And so we feel really good with the companies that we have.
Do you think the industry, so maybe outside yours, will continue consolidating?
I think that there's going to be more consolidation in the industry, partly because I think big distributors are talking about wanting to work with fewer partners, because it's just as expensive to do risk management and due diligence on a big company as it is a little company, and it costs you the same to deploy those resources. So it's kind of easier to work with bigger companies who have independent boutique capabilities. Franklin Templeton has 15 independent investment teams on a risk management platform supporting $1.4 trillion in assets.
Jenny, thank you so much for joining us today. That was Jenny Johnson, of course, the Chief Executive of Franklin Templeton. With that, Matt, I'm going to send it back to you in New York.
All right, Francine, thanks very much. Francine Lacqua there with Jenny Johnson. Really fantastic interview. The idea of giving average investors more access to private markets, I think, is compelling. As Jenny said, it would boost your portfolio 1 to 3%, which is significant over the lifetime of a retirement account. Coming up, unresolved matters. Elon Musk speaks to Bloomberg about his bid for Twitter and much, much more. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York and Anna Edwards in London. Now, Tesla's Elon Musk told Bloomberg there are still unresolved matters about his bid for Twitter, and he sees a recession more likely than not. He spoke with Bloomberg's editor-in-chief, John Micklethwaite, earlier from the Qatar Economic Forum in Doha.
There are still a few unresolved matters. You've probably read about the question as to whether the number of fake and spam users on the system is less than 5%, as Twitter claims, which I think is probably not most people's experience when using Twitter. So we're still awaiting resolution on that matter, and that is a very significant matter. So we're awaiting resolution on that. And then, of course, there is the question of will the debt portion of the round come together, and then will the shareholders vote in favor? So I think those are the three things that stand in the that need to be resolved before the transaction can complete.
What about the general state of the economy? Does that weigh on you when you think about this? I mean, you just described it. You have a super bad feeling about the economy. Are you still in that position? I just said to you earlier, Joe Biden has just come out and said that a recession in America is not inevitable. How do you feel about the economy?
Well, I think a recession is inevitable at some point. As to whether there is a recession in the near term, I think that is more likely than not. It certainly isn't. It's not a certainty, but it appears more likely than not.
Can you set the record straight on one thing, which is this issue about the layoffs? I think you said initially that Tesla, 10% of the workforce would be cut, then 10% of salaried would be cut, then salaried would stay flat and overall headcount would go up. What is the number? I know there's already, I think, been a lawsuit about the 10%. Is 10% the goal to reduce the workforce, or what is the number that we should think about, or that you're planning?
Yes. So Tesla is reducing the salaried workforce by roughly 10% over the next probably 3 months or so. We expect to grow our hourly workforce. It's quite clear that we expect to grow our hourly workforce, but we grew very fast on the salaried side, and we grew a little too fast in some areas, and so it requires a reduction in the salaried workforce. And we're about 2/3 hourly and 1/3 salary. So I guess technically a 10% reduction in the salaried workforce is only roughly a 3.5% reduction in total headcount.
Elon Musk there speaking with Bloomberg at the Qatar Economic Forum a little bit earlier. Now, let's get a look at what we're watching. I'm fascinated by housing markets as I talk to more and more people who decide not to sell because buyers are concerned about higher rates. John Authors wrote a piece on it today. He says, if there's one asset that could come under scrutiny, it is real estate, whose lifeblood is credit. For a double whammy of higher rates and the lasting effects of the pandemic, look to office property. But he also talks in his column, which I highly recommend reading, about residential real estate, as well as the German band Kraftwerk.
Yeah. Right. OK. Well, definitely worth looking at then. Yeah, lots to look at there. I'm watching the UK rail strikes taking place today. This is the biggest strike in some 30 years, in 3 decades. Takes place today, Thursday and Saturday. Will this spread into other areas of the public sector? Criminal trial lawyers, or barristers as we call them in the UK, also on strike. So a big focus on labour markets here in the UK. That is it for this programme. This is Bloomberg.